Even though cyclicals are working over defensives, that tech is still continuing to work. And we see this in semis, we see that in software. So software, for example, on the one hand is a very much a momentum-driven sector, and those valuations have run up. But if you look around the world and we talk about digital transformation, this is all about software. This is where the enterprises are spending, and that's why the top lines of these software are going to continue to go up. And then you look at semiconductors. On the one hand, look, this is a sector that is up 55%, give or take, actually 60% year to date. So maybe you want to step away, but we're looking for revenues to go from negative numbers to positive in 2020. So I still think you have to own semis.
Doc, what kind of action are you seeing in tech?
Ooh, I love the Morgan Stanley note, Judge, about semis and basically taking them to inline. Boy, where have you been, Morgan, on this one? Morgan's made a lot of nice calls. This is really late. Doesn't mean they don't continue to work, Scott. I've got a couple examples today, one that might even be part of the unusual activity, but there is a ton of activity in these names. Apple continues to work. The name we talked about yesterday, Netflix. Tech stock, you bet, especially when people are watching in India and the rest of the world on their devices rather than just through televisions and so forth, Judge. The connected world to Netflix, it exploded higher again today. So you look at the move that stock has made. Josh and I talked about it, I think, on Monday as well. It's way too early to say that Disney Plus or anything else is going to kill these guys. Nothing is going to kill Netflix in the short term. In the long term, it'll be Netflix itself. Does it kill itself?
What about the idea as we run through the names of the stocks, as I did, gave you plenty, as to whether tech is overpriced or too expensive by virtue of the gains that these stocks have had, and everybody's shaking their head no way.
No, I mean, I don't think so. You look at the semiconductors, yes, they have rallied a lot. The multiples have expanded, just like they have with the S&P 500, but they have expanded on the idea of the revenues and the average selling prices picking up. And speaking of things working, when you look at the semiconductor space, there's going to be a lot of things working for semis next year because of the industry trends. For example, we're expecting better auto activity, which will help semiconductors. We're expecting much more 5G acceleration. And speaking of phones, we'll actually be able to hold a 5G phone in our hand next year. So that requires a whole lot more semi content. So for those reasons, I don't think it's too expensive.
Look, when you look at the overall market, let's say it's $27 trillion in the S&P. We've got a return of capital through buybacks, roughly $800 billion, and dividends, $500 billion. So it's a 5% return of capital. You look at the technology sector relative to the whole market, their return of capital is, in many cases, in excess of 5% a year. And the multiples roughly around 20 times. And if you look at where REITs or utilities are, where they've gotten completely built up as a result of lower interest rates, they're selling at 20 times earnings.
I'm sure you're getting the question from a lot of your clients, if not all of them, just given the stature of what you do for the kinds of clients that you serve. What kind of year do you think we're going to have in 2020, Rich? And what do you tell them?
Well, we look at 2020 in two halves. The first half is really where we see continued growth of equities, but around the middle of the year, we're going to be concerned about the return of inflation. So there's two risks we see in 2020. One is inflation potentially, and the other one is the election, obviously, which is very, very much uncertain at this point. So for the next few months, we think that an accommodative Fed, we have a phase one trade deal, Brexit, possible turn in the global situation. We think it's positive for stocks right through the next couple of months.
All right, so let's say, first half of the year presents a pretty good opportunity. Let's bring in Tony Dwyer. He's CANACCORD'S chief market strategist who's sat down at the table with us. That makes sense to you? Top heavy, if you will, 2020 in terms of market gains?
It's an extraordinary situation, Warren. Have you heard Fed Williams earlier today talk about what would make them raise rates, Judge? We talked about this throughout the entire year. The guys printing the money continue to tell you that they're going to print the money and they're not going to raise rates, which gives you this backdrop of the four reasons we're so bullish into next year. Number one, they're going to keep printing the money if anything goes south. And until you get a spike of inflation that with a 50-year low in the unemployment rate you haven't had yet, you're not going to have them raise rates. Secondarily, you've got so much corporate debt being issued, and it's being done at historically low rates, almost a record low in yield for the BAA.